So we are done with cost of capital. From the exemption of the diet to date, we have been discussing cost of capital. And in our last class, we were able to complete the topic. Today, by the grace of God, we are going to be starting a new topic. And this will last for the next 1 month, 4 periods. All right. So let's dive into discussing the topic of the day. So we are going to be looking at capital budgeting. We'll talk about the introduction to capital budgeting, right? We are going to discuss the procedures involved in capital budgeting decision. We'll talk about the characteristics of capital budgeting in the class. I will try my best to explain the project evaluation. All right. Then we are going to proceed to discussing relevant cash flow concepts, how to identify relevant cash flow in a question. Then finally, we are going to discuss the impact of inflation and taxation in capital investments. All of these are what we are going to be discussing in the course of this class. Today, I'll be very happy if I can take you from introduction up to concept of relevant cash flow. All right. So that in our next class, I will just do explanation of the effect of inflation and taxation, and possibly we can have illustrations. Okay. All right then. So what do you mean by capital budgeting? Again, capital budgeting is one of the very interesting topics in financial management. All right. So an average student should be able to do well. We see question under capital budgeting. Okay. So what do you understand by capital budgeting? Capital budgeting is also known as investment appraisal or capital investment decision. Capital investment decision. It represents the process by which an organization commits its funds into long-term projects. When you say long-term projects, they are projects that span over one accounting period. Any project that will last for more than 12 months, they are capital projects, including the construction of roads, dams, bridges, refineries, or office buildings. All right. So those are what we call capital budgets, right? It is expected that the management of a company we do well to commit the limited scarce financial resources of the firm into executing a project that is capable of increasing the value of the company, which will invariably maximize the shareholders' equity value, because these financial resources is limited in supply. Therefore, it is expected that the company will use the funds available judiciously and efficiently to maximize the equity value of the company. All right. So this is basically the introduction to capital budgeting. All right. So let's talk about the steps involved in capital budgeting decision. There are about 6 of them. If I like, I can compress it to 4 or 5, but let's talk about the 6 of them. The first one is identification of potential projects. This involves scanning the business environment to be able to identify the investable opportunities. All right. Basically, within an organization, there is a department that are responsible, depending on the size of the company. All right. Marketing department can be responsible, right? Research and development, R&D development department or unit can be responsible for doing that. Also, business service units embedded within the organization can also scan the business environment to be able to identify any investable opportunity. All right. A whole lot of activity we're going to do that, but the focus of this is just for you to understand that whenever you want to begin a capital budgeting decision, the first step is to identify the opportunity that are in the marketplace, all right, for you to be able to take advantage of. Okay, now, like I mentioned, several activities will go into the identification of the potential projects. However, after the opportunity has been so identified, the responsible person we need to inform the management on the upshot of their findings, all right, through a memo. First thing first, management meeting will be convened to discuss the outcome of their findings. Then thereafter, it will be documented in a memo. So after the first step, another department, which is the finance department, this is where you have responsibility, will be required to go ahead and evaluate the project, whether it is financially viable. The finance director or CFO or finance supervisor or finance manager, whoever is responsible within the organization, within the finance department, will be the one to represent the units in the management team, in the management meeting, to also discuss, because the fact that the company has so much financial resources available is not sufficient to just put the money into executing any project without taking financial due diligence, without ensuring that the project can increase the value of the company. Therefore, it is essential that the project will be appraised, the project will be evaluated to be sure that it is financially viable using relevant investment appraisal technique that is consistent with the capital budgeting guideline of the organization, if any is available, right? So after the appraisal of the project, whether it is financially viable or not, the finance director will need to inform the management as well in a meeting and also document the outcome of their recommendation. All right. So we need to inform the management. If the project is financially viable, the finance director, which is the head of the finance team or finance unit, we need to expressly state to the management that, okay, we have carried out the economic and financial viability of the project, and we recommend that this project should be undertaken. So, but if the project is not financially viable, the same thing, the finance director will also speak up to say that after the analysis being carried out, we come to a conclusion that this project is not worthwhile, therefore should not be considered. Okay, but if the project is financially viable, then it means that management we need to give it a go ahead, a no exemption taking. So there will be no exemption taken in this. In that case, that will take us to step 3. Step 3 is authorization, selection, and approval of projects. Okay, that will be authorization, selection, and approval of projects. So because the project is financially viable, management has given it a good to go. That is, the project should be undertaken. Now that we have gotten management approval, then we need to mobilize people and equipment to site. So that will take us to step 4. In this step 4, this is the stage whereby the company will mobilize the contractor, and then the contractor will bring in the equipment and the people that will do the work on site. Okay, of course, a whole lot of activity will be done, would have been carried out before you get to this stage 4, because depending on the capital budgeting guideline of the organization, you will need to set up capital. There is usually what we call capital budgeting committee. There's also some subcommittees that may be set up, because when you are carrying, depending on the size of the project, Okay, so I don't want to go into that, but uh, after step 4, which is development and execution of projects, so we need to move to step 5. All right. So the fact that you have given some money, or you have paid the contractor to go ahead with the project, doesn't mean that you have to leave the contractor on site to be doing what he or she likes. All right. So you need to monitor the activities of the contractor on site. You also need to control your costs, because every contractor will want to follow shortcuts. All right. And every contractor will want to follow shortcuts. If possible, they can even use substandard material to do the job. All right, because at times they can quote in the contract. They can tell you that, okay, we are going to use 5 bags of cement, and at the end of they may end up using two bags or 3 bags. The remaining one, they know what to do with it. But the bottom line is that, as a responsible organization, you must monitor the activities of the contractor on site by having your own representatives on site. The company will have his own employees, all right, that will be on site. For example, construction engineers, the quantity surveyors, all those kind of engineers that do construction work, or the team that will contribute to the construction activity. So the company we need to deploy them on site so that they can monitor the activity of the contractor from the beginning. All right, from the beginning to the end, the employees of the company will be there just to monitor the activities of the contract. Because if you leave the contractor to 100% to do the way they like. So whatever the outcome, you have to follow it. If anything untold happen on site, then the company will be held liable. And that's why at all time, particularly when you are doing construction activity, different kinds of professionals must be there. Different kinds of professionals must be there on site to ensure that the right thing is done, including the safety people, the safety and health people. They must be there on site, because if there's any incidents or anything like fatality, that can erode the reputation of the company. And that's why you must ensure that from the beginning to the end, you must have your own representative. The other part of this step 5 is the controlling. What are you controlling? You are controlling costs, because your financial resources is limited in supply. You must ensure that the little that you have given to the contractor, they have to use it judiciously. Not only that, you also have responsibility here, you as a finance person, right? You also have responsibility, because you need to monitor cost. You need to control the cost. How do you do that? At all time, on a regular basis, periodically, on a monthly basis, you must prepare stewardship report to the management. Okay, your stewardship report will show the project status. All right, as of today, how much has been spent? What did we budget for? All right, where are we? What do we intend to spend within the next 1 year or two? All right. All of this will show in the stewardship report, indicating that you are monitoring and also controlling your costs. If you want to go above your budget, then your actual spend, your spend trend will tell you where you will be in the next few months or in the next 1 year, so that you need to call the attention of the management that with the trend of our spending to date, there's likelihood for us to outspend the budget. Therefore, we may need additional funds. Management will now ask you, why do you need additional funds? It may well be that there's an extension of time, because each time there's an extension of time, there's likelihood to incur additional cost. All right. So the justification must be there. All right. Anytime your actual spend is different from what you budgeted to spend, you must give justification to the management. You have to tell management, why are you underspending or why are you overspending? You must give justification. All right. It may well be that there's a change in scope. Maybe there's something you wanted to do before on the project, and you are not doing it again. So in that case, your cost will be lower. Your spend will be lower than what you budgeted to spend. So that's a plus. That's what management even wants in any case. However, another part of the change in scope may be that, okay, there's something you did not plan before. Maybe there's a new technology you want to embed in the project. So in this case, you want to introduce something new. As you are introducing it, if the thing will attract cost, then it means that you are going to outspend your budget. You need to go and seek for additional funds from the designated person or decision maker. All right. So these are the things you are going to do as far as monitoring and controlling of cost is concerned. The last step is what we call post-completion investigation or audit. Post-completion investigation or audit. Now, the primary purpose of post-completion investigation is to ensure that the objective at which the project is being executed has been achieved, right? Therefore, during the course of executing the project, there will be lessons learned, there will be mistakes here and there, and this mistake would have been corrected. Hence, it will be done. Usually the mistakes, the errors, or the mistake made by project manager, or the mistake after correction will need to be documented and saved somewhere, so that in case you want to do similar projects in the future, you can always go to your archive, you can retrieve the information from your archive and then learn about the past mistake and how the mistake was addressed, so that you don't repeat similar mistake again. The essence of this is to aid organizational learnings. All right. The essence of this is to aid the experience gain. Certainly, is designed to aid organizational learning. And not only that, during the course of developing, maybe after the project has been completed, there's a defect somewhere on the job done. So you need to call the contractor to come and fix the error or whatever defect that have been identified. And that's why in every contract, there's usually what we call a retention fee, right? Retention fee is a specific percentage of the contract price that is retained by the company for a specified future date. All right. It could be for a year, it could be for 6 months, it could be for 2 years after the project has been completed, before the company will release to the contractor, because it's a kind of a guarantee to the company, just to be sure that what has been done is, I mean, we're okay with it before you release the final tranche of the payment. Otherwise, if the contractor has received the 100% after the job is done, then if you now identify any error, there will be no motivation for the contractor to come back to come and fix the error or to come and fix the defect. But if you have retained a specific percentage of the contract price, certainly if you call the contractor one time, they will they will rush over to come and do the job. All right. So yeah. So these are just the procedures involved in capital budgeting decision. At this level, yes, examiner can ask you. So take your time to review it, understand it, and so that you can speak through the each line item. Okay. The next thing we are going to do is to discuss the characteristics of capital budgeting. Characteristics of capital budgeting. What are the features of capital budgeting? One is that it involves huge capital outlay. A significant amount of money is required to undertake capital projects. All right. For example, some of you, if not all of you, may be aware as about a year plus ago when Dangote refinery was commissioned, right? And Dangote told us that that Dangote refinery is worth over $20 billion. You can imagine the significant amount of money invested. This is not just about Dangote's money, people's money, my money, your money you kept somewhere in the banks are also involved. Investors also contributed, they invested in that particular project. All right. So This is the kind of thing we are talking about. Usually involve huge capital outlay. For those of you that are living in Lagos State, those of you that are resident in Lagos, you might have been hearing for a while. In fact, since the day of Ambode, Lagos State has have been planning to execute or to undertake Fourth Mainland Bridge. You know, we have Third Mainland Bridge in Lagos. So Lagos State wants to undertake the Fourth Mainland Bridge. We started the planning for some years now. In fact, about a year ago or thereabout, I heard in the news that they've selected the contractor that will do the job. I believe it's because of funding. That's why the project, you have not seen the physical construction activity going on about the Fourth Mainland Bridge in Lagos. All right. Because Lagos State government has other project activities that need funding. So, and it's a huge sum of money will be required for that kind of project of Fourth Mainland Bridge. All right, you can imagine even the Third Mainland Bridge we currently have. About 2 years ago or less, some maintenance activity were carried out that worth billions of naira. We're not talking about one, two, about 3 billion plus was spent just for maintenance activity, let alone you want to now construct the entire stretch of the bridge from from the foot of Oronshoki up to Adeniji Adele. So it's a whole lot. It's a whole lot. All right. So in fact, even if you want to construct your own owner-occupier building, you want to construct your own residential building, you know how much you are going to spend into this price. All right. So that's what we are saying. If any organization now, any firm wants to construct high-rise building or office building, it's going to be a lot of money, all right, into this price. Okay. So usually capital budgets involve a huge capital outlay. Then number two is that the benefit will accrue over a long period of time. All right. The benefit will accrue for a long period. Okay. What do I mean by that? You know, when the company is executing the project, when the project is being constructed, the company will just be spending money. It will be cash outflow, right? As soon as the project is completed, then the company begin to reap the reward. For example, if it's an investment property, so you just build high-rise building for the purpose of any rental income, right? By the time the project is completed, you begin to rent it out. Every year you are going to be earning rental income until for the foreseeable future, until the project is no more. All right. Provided the project is still available, then you continue to earn rental income. And this is why we say the benefit will accrue over a long period of time. The next one is that number three, future of capital budgeting is that it involves it is considered to be very risky. Okay, capital budgeting is considered to be very risky. Risky in the sense that it can involve financial losses. Company can lose money when it comes to capital budgeting. Not only that, an incident can happen. You can have a kind of fatality on the project, you know, especially when the project is being constructed. All right, anything can happen. Injury can occur. All right. So it can result to reputational damage. For some of you that are, again, because I stay in Lagos, I will always comment in Lagos based on my experience so far. You know, sometime in 2022 February, there was a high-rise building that collapsed in Lagos State, Ikoyi, somewhere around the Gerard in Ikoyi. And of course, Lagos State government gave an approval for 15-story floor, all right? And then the owner of the property, with the connivance with other government officials, the building was increased to 21-story 21-story high-rise skyscraper. And then on this fateful day, the building gave in and collapsed. The building collapsed on the artisans, collapsed on the youth corpers, collapsed even on the the owner of the property. Almost 50 people died in the incidents. This is a risk. The money that was used to construct that building, where my money, your money were kept in the banks. All right. Some people invested on the project. They contributed their capital to finance the project. Everything is gone. That's a financial risk. That's financial losses we are talking about. Look at the people that died. You can imagine if the owner of the property were to be alive. Of course, how will he be able to face the family of the people of those people that lost their lives too? You know. So this is, of course, that will dent the image of his company. But because the owner is no more, the owner of the property died with the property. All right. So nobody can question his some may even ask, maybe there is a company. A company is a legal entity which is separate from the owners. Yes, it is true. But the assets, such companies, most of these construction companies, they don't have much. Their assets is the property they are working on. They don't really have big property like that can cover the extent of the loan. Because when they are securing the loan, they will inform the bank that, okay, this is what they want to use. In fact, the bank will be working with them hand in hand to ensure that they get their money back. So they don't really have one physical, a particular physical asset that they can use to secure or to securitize the loan that they want to get. So they usually use the project they are working on. Okay, just a kind of a partnership or arrangement with the bank. All right. So, but in any case, that is what we are talking about. That's a financial risk, you know. Another feature of capital budgeting is that it involves irreversible decision. In this irreversible decision, in the sense that because it's a contract agreement between the two parties, between the company and the contractor. So the company cannot say it's not doing again. If you want to rescind your initial decision, if you want to back off from the project, then you have to compensate the contractor. The contractor will not allow the company to go for free. You have to settle the contractor because the contractor will tell you that, see, I have mobilized people and equipment to sites. I have borrowed money to rent all this equipment with interest, and I will need to settle, I will need to settle my creditors. Therefore, you have to pay me so much. If the company is not willing to pay, then there will be litigation. If there's litigation, then the reputation of the company may be in line. And that's why you have to avoid every responsible organization. We want to avoid anything that will impair their image. Okay. So these are some of the characteristics of capital budgeting. So that's that for now. Then we move to um, project evaluation, methods of project evaluation. Before that, let me know if you have any question for me. If not, I will just go ahead with the explanation of methods of project evaluation. I noticed that some of you have just joined. That's good. When we started, we were less than 10, but now a lot of you, more than triple. That's okay. Again, if you just have any question, always raise your hand. So let me just go ahead. Now, let's talk about methods of investment appraisal. Basically, there are two methods of evaluating a project. There are two methods of evaluating a project. See, what we are saying is that before a company commits its funds into executing a project, if you have identified a project or you have a project in mind that you want to execute, it is essential, highly essential, that as a responsible organization, that you evaluate and determine the financial viability of the project before you commit your resources, because your primary purpose as a responsible organization is to maximize the shareholders' wealth. And a company will be able to maximize shareholders' wealth if it is able to create value for the company. Therefore, in order to achieve that objective, a company will need to undertake projects that is likely to increase the value of the business. So in this case, that's why it is important that you carry out the financial analysis. You evaluate the project to be sure that it is worthwhile. Now, to do this, if you want to carry out financial analysis, you want to determine financial viability of a project, there are basically two methods that you can use. The first one is discounted cash flow method, and the second one is non-discounted cash flow method. Therefore, what do you mean by discounted cash flow method? Let's talk about it briefly. All right. So when you say discounted cash flow method, it is a method that considers the time value. It's a method that considers the timing of cash flow and then the time value of money. I repeat, discounted cash flow method. Let me see if I can put it there. Okay. Discounted, or should I use, no, let me just use, don't need to use working notes. Discounted cash flow method represents a method that consider the timing of cash flow and time value of money. Okay. Now, the time value of money connotes that the value of 1 naira of today is worth more than the value of 1 naira of tomorrow due to price level changes, that is inflation, and then the investor's preference to have their benefits now. That is the idea behind the time value of money. All right. So what are the techniques under the discounted cash flow method? For the purpose of this class and as consistent with your syllabus of financial management. So under the discounted cash flow method, we are going to discuss the net present value. We will discuss internal rate of return. Those are the two methods, two techniques that we are going to discuss. Profitability index and benefit cost ratio. Mr. Ashiwaju will take you capital rationing. So you are going to discuss profitability index under capital rationing. You can either use profitability index or benefit cost ratio. Okay, benefit cost ratio to rank the project. So it will tell you, we'll be discussing that when he's doing capital rationing with you. Modified internal rate of return is not part of the scope of your syllabus. Okay. All right then. Then before we begin let me just explain the discounted cash flow techniques once and for all before we come back to the non-discounted cash flow method. Let's talk about net present value. What do you understand by net present value? Net present value represents the difference between the present value of cash inflow and present value of cash outflow in capital investment. I repeat, net present value represents the difference between the present value of cash inflow and present value of cash outflow in capital investments. The NPV is a measure of absolute profitability, and it is a technique that is consistent with the shareholders' wealth maximization objective. The concept of net present value or the net present value technique is the most is considered to be the overall of investment appraisal techniques. Okay, is the overall in theory, not in practice. So it's the most used kind of technique to evaluate projects. But because of the fact that is considered net present value is considered the overall because of the fact that it is in consonance, all right? It is in line with the shareholders' wealth maximization objective. And you know that the primary purpose of any organization is to maximize the owner's equity value. So any technique that is consistent with achieving that objective will be considered to be the best, because it is believed that a positive NPV will increase the value of the company, and which will invariably maximize the wealth of the owners. All right. So that is basically what NPV is all about. Then at this level, examiner can ask you the advantages and disadvantages of NPV. So do well to read them through. I will not be mentioning it. They are very straightforward. Do well to understand, to read it and then form a note on that. Then let's talk about how to estimate NPV. Even though we have done this in the when we are doing cost of capital, but let me just mention it to you. Okay, how do you estimate net present value? There are two ways you can calculate the net present value. You can either use formula or you use tabular method. During the course of dissecting or discussing the cost of capital, we use this table to calculate cost of redeemable preference share, cost of redeemable debt, or cost of convertible securities. It is the same format. So this is the format for calculating NPV. If you want to use the tabular method, this is what you are going to do. Then if you want to use the formula, then let me just write it out for you. Formula for calculating NPV. You will recall that I just mentioned that NPV represents the difference between the present value of cash inflow, and the present value of cash outflow in capital investment. That's the definition of NPV. So if I want to use formula to calculate NPV, then I can say net present value equal to, first thing first, I need to calculate the present value of cash inflow. So to do this, I will need to go to the question, what are the cash inflow given to me? I will pick the cash flow of the first year, cash flow of year one. I will discount it using discount factor of year one plus cash flow of year two. I will discount it using the discount factor of year two. You continue like that until you get to the final year. So you then pick the cash flow of the final year. You discount it with the discount factor of the final year. So all of this will represent the present value of cash inflow. You then deduct the present value of cash outflow. All right. So this is the formula for calculating NPV. This is the formula for calculating NPV. If you are using formula, whether you use this formula or you use this table, all right, you are going to arrive at the same answer, except with some rounding error, except with some rounding error, because you are going to round your discount factor, and that will make your final answer not to be close to 100%. All right. Okay, so I can then say where CF equal to cash flow of each year, then N, R equal to company's cost of capital. Okay, company's cost of capital. Then N is the useful life of the project. Then CO equal to cash outflow, present value of cash outflow. Okay, so that's that. This is how to calculate the net present value. Now, Of course, it is expected that you know how to calculate annuity factor. And this is the formula for calculating discount factor to perpetuity. All right. And this is the formula for calculating discount factor. All of this, we have done it under cost of capital. So I don't need to mention it to you again. Now, what are the decision rules for NPV? What are the decision rules? Number one, for independent projects, okay? For independent projects, you accept if NPV is positive, provided the NPV of the project is positive. That means the project is financially viable, then it should be considered. But if NPV is negative, the project is not viable and should be rejected. What if you have zero NPV? Where you have zero NPV, the company can either accept or reject depending on other qualitative factors, okay? That is what you need to do where you have independent projects. The second one is where there is mutually exclusive projects. Okay, where there are mutually exclusive projects, accept any project with a higher positive NPV. All right, accept any project with a higher positive NPV. Okay, so that's what you need to do. Examiner can ask you to explain or discuss independent projects, one. Two, mutually exclusive project. So you need to know what is independent project, what is mutually exclusive project. So let me give it to you. Independent project is a standalone project. This is a standalone project. This is a standalone project that may be accepted or rejected based on its own merits. Based on its own merits. For example, if the project produces a positive NPV, let me write it. If the project produces a positive NPV, it will be accepted. But if negative NPV, to be consistent, but if a negative NPV, it will be rejected. So this is what we mean by independence projects. So if your examiner is asking you to explain or discuss independent project, this is what you are going to say, that independent project is a standalone project that may be accepted or rejected based on its own merits. It is not sufficient for you to just define what independent project is. You have to give an example to demonstrate that you know what you are doing. All right? You have to give an example. Okay. So if the project produces a positive NPV, all right, that means the project is financially viable and it should be accepted. But if it generates a negative NPV, that means the project is not financially viable. It should be rejected. So that is independent project. What do you then mean by mutually exclusive projects? What is mutually exclusive project? A mutually exclusive, let me put it down. Mutually exclusive projects are competing projects These are competing projects. These are competing projects that may be accepted. These are competing projects. In which the acceptance of one will preclude that is, prevent the acceptance of the other. So that is what mutually exclusive project is all about. They are projects that cannot be undertaken together. For example, if projects A and B are mutually exclusive, the acceptance of project A will result in the rejection of project B and vice versa. Okay, so that's what mutually exclusive project is. So you are not when you are asked to explain or discuss independent or mutually exclusive project, after your definition, you have to give examples for you to be able to earn your full mark. All right, you have to just give examples. Okay, so that's basically that. What else? So that's all about the net present value. So let's talk about the internal rate of return. Let's talk about internal rate of return. After internal rate of return, we then discuss the non-discounted cash flow method. So what do you mean by internal rate of return? Internal rate of return is also known as the break-even rate of return, market discount rate, or this yield to maturity. You can call it break-even rate, market discount rate, or yield to maturity. Okay, yield to maturity. That's internal rate of return. It is the rate that equates the net present value of the expected future cash flows to zero. Any rate that you assume and produce zero NPV, that is your internal rate of return. The internal rate of return uses trial and error method of interpolation. Okay, it uses trial and error method of interpolation. There are basically three steps you will carry out anytime you want to estimate the internal rate of return. Step one is to assume two discount rates that will produce a positive and negative NPV. I repeat, to calculate internal rate of return, you are expected to assume two discount rates that will produce a positive and negative.
Excuse me, sir. Hello, sir. Please, can you hear me? Hello.
So I was talking about the procedures involved in calculating internal rate of return. And I said that the first step is to assume two discount rates that will produce two opposing NPV, that is a positive and then negative NPV. Then step two is to calculate internal rate of return using the internal rate of return formula. All right, of course. Well, you're already familiar with this formula because it's the same formula we use under cost of capital when we calculated cost of redeemable preference share, cost of redeemable debt, and then cost of convertible securities. This is the same formula that we used. Then step three is to advise whether the project is financially viable. So this will then take us to the decision rule for internal rate of return. Again, for independent projects, accept if your calculated IRR is greater than the company cost of capital, okay? You accept if the calculated IRR is greater than the company's cost of capital. Then for mutually exclusive projects, accept any project with a higher IRR, provided it is greater than the company cost of capital. Okay, now you will see that for the purpose of acceptability of a project using internal rate of return, your calculated IRR is usually benchmarked against the company's cost of capital. So provided your calculated IRR is greater than the company cost of capital, it means that the project is financially viable and then should be accepted. Okay, so again, ensure you read about the advantages and disadvantages of internal rate of return. Okay, so that's basically what internal rate of return is all about. Now, you have to bear in mind that just like we did under cost of capital, when you are calculating internal rate of return, don't go and be looking for discount company. This one that's why today? Why is network trying to frustrate? Okay, let's just move on. Let me see. Uh, where are you? Okay. All right. So the next thing we are going to, don't forget what I said. Please ensure that you go through the advantages and disadvantages of all the techniques. You must read the advantages and disadvantages of all the techniques because at this level, it is examinable. It is examinable. All right then. Before we move to non-discounted cash flow method, let's talk about areas of conflicts between NPV and the internal rate of return. Now, where there are mutually exclusive projects, the decision of NPV may be conflicting with the decision of internal rate of return. Okay? Because NPV can accept a project and internal rate of return may suggest another project. And this is an apparent conflict that needs to be resolved. All right. Therefore, what are the causes? What is causing the conflict between NPV and then the internal rate of return? The first one is significant difference in the amount of capital outlay. All right. When you talk about the conflict between NPV and the internal rate of return, one of the major causes is significant difference in the amount of capital outlay. Number two is the difference in cash inflow patterns. Difference in cash inflow patterns. All right, I will explain this later on using hypothetical figures. Then number three, reasons for conflict between NPV and internal rate of return is difference in useful life or unequal expected life of the projects. Okay, these are the major causes of conflict between NPV and then internal rate of return. Again, this particular scope is highly examinable. In the past, examiner can ask you to explain or discuss the causes of conflict between NPV and internal rate of return. How do you resolve the conflicts, or how can you resolve the conflicts? All right, all of this you have to know it. It's part of your syllabus. So let me explain deeper the causes of conflict between NPV and internal rate of return. Let me use this small space. Let's say, for example, we have project A and then project B. Let's say project A has initial outlay of 500 million naira. Project B has initial outlay of 800 million. So let's say we have year 1, year 2, year 3, year 4, and then year 5. Project A, year 1, has cash inflow of 300 million. Year 2, cash inflow of 250 million. Year 3, cash inflow of 180 million. No cash flow in year 4 and 5 for project A. For project B generated cash inflow of 100 million in year 1, 150 million in year 2, okay, 220 million in year 3, 300 million in year 4, then 350 million, for example, in year 5. Now, let's say we also have discount factor, for example, at 10%. Discount factor at 10% for year 0 is 1. Year 1, 0.909. Year 2, 0.826. Year 3, 0.751. Year 4, 0.683. Then year 5, 0.621. Now, what we are saying is that we want to use these hypothetical figures to explain the reasons for conflicts between NPV and then internal rate of return. The first causes of conflict is significant difference in the amount of capital outlay. When you look at the hypothetical figures for project A and B, you will notice that the initial outlay of project A is 500, that of project B is 800. There's a difference of 300 million. Therefore, because there's the two projects have different capital outlay, and the difference is significant. So when this happens, the decision of NPV may be conflicting with the decision of internal rate of return. So this is what I mean by significant difference in the amount of capital outlay or initial outlay. The second reason is difference in patterns of cash inflow. Now, when you look at project A, you will notice that project A has higher cash inflow at the earlier part, which is 300 million. At the latter part, project A generated a lower cash inflow of 180 million. On the flip side, when you look at project B, you will see that at the earlier part, project B generated annual cash inflow of 100 million. And at the latter part, project B attracts a higher cash inflow of 350. Look at the pattern of the cash flows between the two projects. And you will agree with me that discount factor at the earlier part of a project is always higher relative to discount factor at the latter parts. Therefore, any project that has a higher cash inflow at the earlier part may be favored over the other project with a lower cash inflow. Okay, so this is what I mean by difference in patterns of cash inflow. Okay, because if you multiply 0.909 by 300, you are going to have almost 270 something million. Whereas if you multiply the same discount rate of the same discount factor of 0.909 by 100, you have 90.9 or rounding 91 million. All right. So any project that has a higher cash inflow at the earlier part may be favored over the projects with a lower cash inflow. Okay. Then the third one is difference in useful life or uneven life of the project. You can see that project A has 3 years life, whereas project B has 5 years life. Project B has opportunity to recover to generate additional cash inflows for year 4 and year 5. When you have this kind of uneven project lives, then in this case, one project may be favored over the other, which is causing the conflict between decision of NPV and then the internal rate of return. So in case you are asked to explain or discuss the causes of conflict between NPV and internal rate of return, these are the things we are going to be talking about. I believe with these hypothetical figures, you already know the reason why, all these things, all the points I mentioned earlier. Now, examiner can I ask you, how do you resolve the conflicts? Okay, how to resolve the conflicts? Let me write it. How do you resolve the conflicts between NPV and then internal rate of return? So when choosing between mutually exclusive projects, when you are selecting between mutually exclusive projects, your decision should be based on the net present value criterion. Why? Because NPV is a measure of profitability and it is consistent with the shareholders' worth maximization objective. So when ranking mutually exclusive projects, all right, the NPV criterion is more reliable relative to internal rate of return or any other techniques, all right, or any other techniques. That's why I mentioned earlier on when I started to tell you that NPV is considered to be the overall investment appraiser technique because primarily it is in consonant, is in line with the shareholders' worth maximization objective. because a positive NPV generally will increase the value of the company and which will invariably maximize the shareholders' wealth. All right. So that's why NPV, anytime you have mutually exclusive projects, you have other techniques, maybe in a question, examiner is asking you to calculate NPV, internal rate of return, payback period, accounting rate of return. Then number B, advise whether the project should be selected. At all time, your advice should be based on the NPV criterion. You have to use NPV to advise on the acceptability of the project, except examiner is specific, except examiner wants you to use a particular technique to do your advice. Otherwise, your decision should always be based on NPV because NPV is more reliable it's more reliable as compared to any other techniques, including the internal rate of return. So this is how to resolve the conflict between NPV and then the internal rate of return. So at this point, we can then move to discussing the non-discounted cash flow method. Again, like I said, if you have any question, always raise your hand. I will allow you to talk so that, yes, let's go to non-discounted cash flow method. The non-discounted cash flow method is a method that does not consider the timing of cash flow and the time value of money. I repeat, non-discounted cash flow method is a method. Let me put it down for you. Let me just go there and put it down. Okay? Non-discounted cash flow method. Non-discounted cash flow method. Represent the method, or is a method that does not consider the timing of cash flow and time value of money. Okay. The techniques under the non-discounted cash flow method include the payback period and then accounting rate of return. The first method is payback period and accounting rate of return. So let's talk about payback period. What do you mean by payback period? The payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow in capital investments. The payback period is a measure of liquidity. That is, how quick can the company recover or recoup the amount invested in a project? Okay, so that is what payback period is all about. If a company invests, for example, 100 million naira, you want to know how long will it take you to recover your 100 million naira? That is what payback period measures. All right. And to calculate payback period, cash flow is needed. If you are given accounting profit or loss, you need to convert it to cash flow. I will explain to you later on how to do that. But for now, so that's basically what payback period is all about. Again, please ensure you read the advantages and disadvantages of payback period. Okay? Somebody is sending a message.
Sorry, sir. I think I lost you there when you were explaining payback period.
You did what?
I lost you for a moment when you were explaining payback period. I don't know if you can quickly recap.
I said payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow in capital investments. And it is a measure of liquidity. That is, how soon can a company recover or recoup the amount invested in a project? All right. And I said, say for example, if a company wants to invest 100 million naira in a project, you want to know how long will it take you to recover your 100 million naira, all right? And that generally, when you are calculating payback period, not even only payback period, all the investment appraisal techniques use cash flow, except accounting rate of return, which uses accounting profit or loss. Therefore, if you are given accounting profits or accounting information, you are supposed to convert it to cash flow. And I said I will show you later on how to convert cash flow to accounting profit or accounting profit to cash flow. All right. So I also mentioned that please ensure you read about the advantages and disadvantages of a payback period. They are pretty straightforward and simple to understand. All right. So that's what Tony, that's what I said. I believe that's
Thank
clear,
you.
right?
Yes, boss. Thank you.
You're welcome. All right then. So apart from the knowing what payback period is, you also need to know how to estimate payback period. So how do you calculate payback period? There are two ways in which you can estimate payback period depending on the nature of the cash inflow, right? So if you are given constant cash inflow, if you are given regular or constant cash inflow, then payback period is calculated as the ratio of cash outflow to constant cash inflow. That is, if you are given constant cash inflow, just divide the cash outflow with the constant cash inflow, and then that will be your payback period. At all time, whatever you have calculated as payback period must be expressed in years, because you have said it in the definition that payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow. All right, your final answer must be expressed in years under payback period. Okay, so what do I mean by constant cash inflow? Let's say, for example, you are given cash flow, you are given information like this for a project. You are given initial outlay to be equal to 10,000 naira for simplicity. Then you are given cash flow. You are given cash flows of 5,000 naira. Let me use 4,000. You are given cash flow of 4,000 naira. Then you are given the useful life of the project to be 3 years. Okay, you are given the useful life of the project to be 3 years, and you are asked to calculate the payback period, right? So when you look at the cash flows given to you, we have 4,000 naira per annum. Year 1, 4,000. Year 2, 4,000. Year 3, 4,000. So that means the 4,000 is constant. It is regular. So in this case, if I want to calculate my payback period, I would then say payback period is equal to cash outflow over cash inflow. Therefore, cash outflow is the 10,000 you want to invest. So that's the 10,000 here over constant cash inflow. Our 4,000 for each year is constant. Therefore, my payback period, how many times can 4 goes in 10,000? 2 times. So this will give you, was it 2.5 or 2.2? Let me check. Using the calculator.
That's 2.5 times.
So that would be 2.5. That would be 2.5. Okay, 2.5 years. So this means that this project will pay back in 2 years and 5 months, or 6 months rather, 2 years and 6 months. All right, 2.5 years. So this is how to calculate payback, where you have constant cash inflow. Okay. But where you have irregular cash inflow, if the cash flow given to you are not the same for each year, you cannot use the formula. You have to use tabular method. All right. So tabular method is used to calculate payback period where you are given irregular or non-constant cash inflow. For example, in this table, in this hypothetical table, initial outlay of the project is 100,000 naira. Only this information will be given to you in the question. For example, so you are the one that will create additional column for you to be able to calculate your payback period. So in this case, based on the information given, you will see that the cash inflow for year one is 40,000. Cash inflow of year two, 70,000. Cash inflow of year three, 30,000. They are not the same cash inflow for each year. Therefore, they are irregular. They are non-constant. So if I want to calculate my payback period, I will then create additional column like this, cumulative balance, or simply call it balance, right? So in year zero, the amount invested in this project is 100,000 naira. That's what you want to recover. You want to know how long will it take you to recover your initial investment. In this particular scenario, initial investment is 100,000 naira. Therefore, you are going to be using the cash inflow to recover the initial investment. So in year one, this project generates annual cash inflow of 40,000 naira. Therefore, 100,000 minus 40,000 will give us a balance of 60,000 naira. That means at the end of year one, the company has recovered 40,000 naira. There is a balance of 60,000 naira to be recovered. So you then move to the next cash inflow. The next cash inflow is 70,000. When you get to a point where the outstanding balance of the preceding year is lower than the next cash inflow, you need to put a dash and calculate the payback period. So in this case, you then ask yourself, how many years have you recovered? You have only recovered for year one, which is the 40,000 naira. Therefore, you say one plus the outstanding balance. Outstanding balance is 60,000 naira over the next cash inflow of 70,000 naira. So that's what produced the 1.86 years. That means this project will pay back the initial investment of 100,000 naira within 2 years. That's the interpretation. Let's say, for example, the first year cash flow is 30,000. Okay. The second year cash flow is 50,000. The third year cash flow is 60,000. It's still the same thing. In this case, I would then say payback period is equal to, now, I'll pick my 100,000 naira. 100,000 minus 30,000 will give me 70,000. So here will be 70,000 balance. I have a balance of 70,000 after year one. I will then move to the second year. 70,000 minus 50,000 will give us 20,000. At the end of year two, we have recovered 80,000 naira out of the 100,000 naira invested. So we have a balance of 20,000 naira to recover. So I will then move to year three. The outstanding balance in year two is less than the next cash inflow. Therefore, I will put a dash. Then I will calculate the payback period. In this case, how many years have I recovered? I've recovered for 2 years. Year one, I recovered 30,000. Year two, I recovered 50,000 naira. So I would then say 2 plus the outstanding balance of 20,000 over the next cash inflow of 60,000. Okay, so this will give me the payback period. So that's that. This is how to calculate. This is how to calculate payback period. This should be 2.33 years, or just say 2.3 years or thereabout. Okay. So that means this project will pay back within 3 years. So that's that. This is how to calculate payback period. Then, what's the decision rule? What's the decision rule for payback period? Again, for independent projects, accept if payback period is shorter or equal to management predetermined payback period. I repeat, for independent projects, accept if payback period is shorter or equal to management predetermined payback period. Then 2, for mutually exclusive projects, accept any project with a shorter payback period, provided it is equal to or shorter than the management targeted payback period. I repeat, for mutually exclusive projects, accept any project with a shorter payback period, provided it is equal to or shorter than the management targeted payback period. Now, when you look at the decision rule for payback period, you will notice that emphasis is on management predetermined payback period. So you are expected to compare your calculated payback period with the management targeted payback period when you want to make a decision as to the acceptability of the project. So under payback period, you do not compare your calculated payback period with the useful life of a project. That is wrong. You have to compare your calculated payback period with the company's targeted payback period. You have to use you are going to benchmark your calculated payback period with the management targeted payback period. However, if in a question you are not given management targeted payback period, that means there will be no basis for the acceptability of the project, because you are supposed to use the management targeted payback period to compare with the payback period that you have calculated in order to ascertain whether the project should be undertaken or not. All right. So in a situation whereby you are not given the management targeted payback period, the most important thing to say is that the project will pay back within so period. Whatever you have calculated, just say that the project, for example, now in this one that we have 2.5 years, I can say that the project will pay back within 3 years. However, management targeted payback period is not given. Therefore, there is no basis for the acceptability of this project. That's what you are going to say. But if you are given management predetermined or targeted payback period, then you can then compare your calculated payback period with what examiner has given to you as the management targeted payback period. So this is what we are supposed to do as far as payback period is concerned. Okay. All right, so that's all about payback period. The last one under the non-discounted cash flow method is the accounting rate of return. Now, before we go to accounting rate of return, there's one more technique under the discounted cash flow method, which is the discounted payback period. I purposely ignore it because I know when I get to payback period, I will need to mention that. All right. So discounted payback period is calculated the same way as the normal payback period. The only difference is just that the cash flow should be discounted before calculating the payback period. You have to, when you are calculating discounted payback period, you have to discount the cash flows before you calculate your payback period, which simply means that you are using the present value to recover the initial investment. You are using present value to recover the initial investment. That's all you need to do as far as discounted payback period is concerned. So in this place where you have cash flow, you are going to introduce additional column for discount factor, then additional column for present value, then you now have the cumulative balance. You then use the present value to recover the initial investment. Let me just show you. the format for the discounted payback period. Anytime you want to calculate discounted payback period, this is the format. Okay, so like I said, you create a column for year, description of items, then cash flow, discount factor, then you create another column for present value, then you have cumulative balance. All right, so this is the format for calculating discounted payback period. So whatever is the year given to you in the question, the cash flows will always be given to you. The cash flow will always be given. All right, so indicate the cash flow. Put in the discount factor for each year. You then get the present value. You are the one that will determine the present value. Then you then use the balance to recover the initial investments. Okay, that's it. This is the format. So instead of using cash flow to recover the initial investment, you are using present value. You are going to use present value because you have to discount the cash flows before you calculate your payback period or when calculating your payback period. So this is just the difference between the normal payback period and then the discounted payback period. So let's talk about accounting rate of return. Let's talk about accounting rate of return. What do you know by accounting rate of return? The accounting rate of return is also known as return on investment or return on capital employed. I repeat, accounting rate of return is also known as return on investment or return on capital employed. It is one of the non-discounted cash flow method that relies heavily on the accounting information as shown in the financial statement of a company. All right, accounting rate of return relies heavily on accounting information as shown in the financial statement of a company. The accounting rate of return is a measure of profitability. Unlike payback period that measures liquidity, accounting rate of return measures profitability. Therefore, when calculating accounting rate of return, accounting profit or loss should be used. You have to use accounting profit or loss. So in this case, if you are given cash flow, you don't use cash flow for calculating accounting rate of return. So if you are given cash flow, you have to convert it to accounting profit or loss. Let me see if I have it. If I don't have it, then I will show you. Now, this is what we are saying. If in a question, you are given cash flow and you want to determine accounting profits, so profits is calculated as cash flow minus annual depreciation. Annual cash flow minus annual depreciation will give you accounting profit or loss. If in the question, for example, you want to convert, you are given profit, you are given accounting profit, and you want to determine cash flow, then the reverse will then be the case. It will be cash flow will be equal to profit or loss plus depreciation plus annual depreciation. That will give a cash flow. In most cases, examiner will give a cash flow. They will then ask you to calculate the accounting rate of return. So that's that. Now, again, please ensure you read the advantages and disadvantages of accounting rate of return. These are purely, they are very examinable. They are very examinable. You have to know them. Therefore, how do you estimate accounting rate of return? How do you calculate accounting rate of return? Now, anytime you want to calculate accounting rate of return, there are 4 steps that you are going to carry out. Step 1 is to calculate annual depreciation. You must calculate annual, that's your first thing. That's your first step that you are going to carry out. This is your first step. calculate annual depreciation. How do you get your annual depreciation? Depreciation is the project cost minus scrap value over the useful life. That will give you the annual depreciation. After you have determined the annual depreciation, you also need to calculate average annual investments. Okay? Step 2 is to then calculate average annual profits. Average annual profits. AAP. How do you calculate average annual profits? All right. So the average annual profit will be computed as total profits over the useful life of the project. How do you get your total profits? In most cases, examiner will give to you cash flow. Therefore, you are going to pick the cash flow of each year. You deduct annual depreciation. Then you now divide it by the useful life. You divide it by the useful life. So this will give you average annual profit. So to get your total profit, it will be cash flow of each year, annual cash flow minus annual depreciation for each year. Then you add all of them together to get the total profit. Just divide it by the useful life. So it will give you average annual profit. If you want a format, for example, for average annual profit, average annual profit, AAP. So this is the format. You create a column for year, annual cash flow, annual depreciation, then annual profits. So let's say you have 3 years for this project. So you pick the cash flow for each year. Let me use number. Let's say, for example, the cash flow given to you for year 1 is 10,000 naira. Year 2, 5,000. Year 3, 7,000. Now, let's say you have calculated annual depreciation to be 4,000 naira. You have calculated annual depreciation to be 4,000 naira. Therefore, to get the annual profit, it will be cash flow minus depreciation. 10,000 minus 4,000 will give us 6,000, 1,000, then 3,000. So to now get the average annual profit, I'm supposed to add up all the profit together, profit for each year. So 6,000 plus 1,000 plus 3,000 will give us 10,000 naira. This represents the total profits. So to now get the average annual profits, I will then say the total profit of 10,000 naira over the useful life of 3 years. So this will give me average annual profit should be around 3,000 plus. Let me see, where's my calculator? So 10,000 divided by 3. That's 3,333. So average annual profit is 3,333 naira. That's it. This is how to calculate average annual profit. That's step 2. Step 3 is to calculate average investments. Okay. Step 3, you calculate average investments. How do you calculate average investments? You are going to add the initial cost of the project cost plus the scrap value. Because you added 2 elements, 2 items together, you divide it by 2. So that will give you average investments. Then after you have calculated the average investments, you then go ahead to calculate the accounting rate of return, which is step 4. In this case, accounting rate of return is average annual profit over average investment. So it's as simple as that. It's as simple as that. This is how to calculate accounting rate of return. So finally, under this, let's talk about decision rule. Again, please don't forget, I've already advised you to read about advantages and disadvantages of each of the techniques. All right, so let's talk about the decision rule. For independent projects, accept if accounting rate of return is greater than or equal to the management predetermined accounting rate of return. Okay, you accept if your calculated accounting rate of return is greater than or equal to management intended accounting rate of return. Then B, for mutually exclusive projects, you accept any project with a higher accounting rate of return, provided it is greater than or equal to management targeted accounting rate of return. Okay, targeted accounting rate of return. You also notice that you are benchmarking, you want to benchmark your calculated accounting rate of return with the company's targeted accounting rate of return. So what this simply tells you is that for the non-discounted cash flow method, your calculated figures should be compared with the management targeted figure. All right. So in this case also, if you are not given the management targeted period, there will be no basis for the acceptability of the project because for accounting rate of return, you are supposed to compare your calculated accounting rate of return with the management predetermined accounting rate of return. So what I'm now saying is that if you are not given the management targeted accounting rate of return, there will be no basis to compare your calculated accounting rate of return. Okay, you can't say the project should be accepted or not because you are not given the management targeted. All right, so that's basically that. Okay, so that's that. That's end of the explanation of the four techniques or five techniques in relation to project evaluation. These are the techniques of project evaluation. So far, we have talked about net present value. We talked about internal rate of return. We talked about payback period, discounted payback period, and number five, accounting rate of return. So where we are going to stop today, let's talk about relevant cash flow. Let's talk about relevant cash flow, and that's where we are going to stop the class for today. So, all right, so let's talk about relevant cash flow. Now, you see, let me see. So we want to discuss how to identify relevant cash flow. Okay. Now, on the day of your exam, if you are given question on capital budgeting, for example, you have NPV, you have to calculate NPV or internal rate of return or any one, maybe a payback period as well, right? So different, especially if it has to do with compulsory question. If you have compulsory question if you have capital budgeting as a compulsory question, certainly it will be a longer kind of a scenario. You may have 1 or 2 pages kind of question. Therefore, different information will be provided for you in the question. So you then have responsibility to be able to identify which of the cash flow given to you are relevant, which one are not relevant. For those of you that are doing performance management, this is closely related to relevant costing, all right? But there's a slight difference, but they are very close. Now, when you talk about when you want to evaluate a project or you want to ascertain financial viability of a project, there are three variables that must be present. One is relevant cash flow, two is appropriate cost of capital, then three is the useful life of the projects. The three of them are very essential. All of the three are very important. You cannot miss one. If one is missing, if one of the variables or factors is missing, that means there is no way you'll be able to ascertain the financial viability of a project. I repeat, in the determination of financial viability of a project, there must be two key variables available. One is relevant cash flow, two, appropriate cost of capital, then three, useful life. Because when you talk about relevant cash flow, not all cash flows are relevant. So only the cash flow that will be attributable to the project under consideration are relevant. Then the second one is appropriate cost of capital. The cost of capital to be used to discount the future expected cash flows must be consistent with the risk associated with the project. All right? The cost of capital must be consistent with the risk, with the business, systematic business and financial risk associated with the project. And that's why we have done cost of capital before now. Then the third one is useful life. Every project must have a useful life in the determination of the financial viability. All right. So these are the basic requirements for financial for project evaluation or to determine financial viability. All right.
Sorry, sir.
So
I was thinking maybe you can just help us to write it, probably at one corner of this note.
write down what?
The three factors: the relevant cost, the capital, and the useful life.
Okay. That's additional work. Oh. You paid me for additional extra effort too. Tony, do
Yes,
you
sir.
agree?
Yes,
Do you
boss.
agree? Yes or no?
Yes.
Okay, you have committed yourself. You have to pay me. All right, then. Let me just explain. I said there are three criteria. You can call it factors. Criteria, determinants. Okay? We call it attributes. Okay? Of determining attribute of financial viability or of project evaluation. You can call it determinant of project evaluation, or say financial viability of a project. There are three of them. This include number one, relevant cash flow. What do I mean by relevant cash flow? These are cash flows. These are cash flows that are directly attributable cash flow, let me call it cash flow of receipts. Cash flow of receipts and payments that are directly attributable to the projects under consideration. To the project under consideration. Okay, so I don't need to be explaining relevant cash flow again since I've already defined what relevant cash flow is all about. So then before we begin to, okay, let me do it. No, I would have started from let's say I'll just start from appropriate cost of capital useful, that I'll make relevant cash flow the last one so that I can give you the details, but no worries. Let me just go ahead. Okay, so in the determination, let's do our explanation now. Thank God, Tony, you are the one that made me to expand this scope. Oh yeah. So in the determination, in the determination of financial viability of a project, the following line item the following line items must be critically examined. What are the line items? Number one, let me give a space. Number one, variable cost. Now, what we are saying is that in relation to relevant cash flow, like I mentioned earlier, not all cash flow that will be given to in the question are relevant. So only cash flow that are directly attributable, the cash flow of receipt and payment that will influence the decision that you want to take, are the ones that are relevant. Those are the ones that are directly attributable. So one of those cash flows is variable cost. We then say variable cost, just as you know, variable cost, this represents the cash flows or the costs. This represents the costs that will vary or that vary. This represents the costs that vary according to activity level. Let me write that. According to activity level or production volume. So that is variable cost. Examples include direct material costs, direct labor, direct expenses, and variable overhead. Variable overhead. So these are examples of variable cost. Therefore, variable costs are relevant cash flow and should be considered. So what we are saying is that in any question, when you are given variable costs, when you are given direct material, direct expenses, okay, direct labor, variable overhead in a question, they are relevant cash flow, and you have to consider it, you have to take it. All right. So that is variable cost. Another item will be fixed cost. Fixed cost. These are costs that have no sympathy . These are costs that have no sympathy for activity level. That is, irrespective of the production volume or activity level, fixed costs will remain unchanged. Okay? Therefore, fixed costs are irrelevant cash flow and should be ignored. Except it is incremental in nature. So all fixed costs are irrelevant costs, except it is incremental in nature. That will take us to number 3 item. Let me call this one A. We are still discussing A. We are going to B will be appropriate cost of capital, then C will be useful life. So we are still discussing A. So if fixed cost is irrelevant, then what are the relevant fixed costs? So I can then say direct slash incremental slash attributable slash specific fixed cost. Okay. These are relevant cash flow and should be considered. These are relevant cash flow and should be considered. So if in a question you are given direct fixed cost, you are given incremental fixed cost, attributable fixed cost, or specific fixed cost, you have to consider it. You have to include it in your calculation. They are relevant. Okay. The number 4, we have historical costs, historical slash sunk costs. Okay. Historical slash sunk costs. These are costs. These are costs that have already been incurred. Examples include, that is, they are past costs. Let me put it. That is, they are past costs. Examples include, what are the examples of sunk costs or historical costs? You can have market survey, or you can have market survey costs. research and development R&D. We can have feasibility study fee. So these are examples. These are examples of sunk costs. Therefore, historical costs or sunk costs, historical or sunk costs are irrelevant cash flow and should be ignored. So if in a question you are given market survey costs, you are given research and development, you are given feasibility study fee or cost, you should know that they are sunk costs. The costs have been incurred before the project begins. Therefore, they are not relevant and should be ignored in the calculation. So that's all. That's what we are going to, because in most cases, when you are given capital budgeting question as compulsory, all this information, you will have it in a question. That's why the question is usually very voluminous. All the information relevant and irrelevant, they will put, the examiner will put them in a question. So you have the responsibility to be able to identify which of them is relevant, which one is not relevant. We are still going to item number 8. So number 5 now. Let's talk about non-cash item like depreciation or amortization or provision. When you see them in a question, what are you supposed to do? All right. These are non-cash items. These are non-cash item or notional costs or notional costs. And therefore, okay, let me put it this way. Notional costs and should be ignored and should be ignored because they are not cash flow. Because they are not cash flow, or they don't relate to, they don't involve movement of cash. So that's that. That's the treatment of, if you see depreciation in a question or you are given provision or amortization, they are not cash flow. When you want to determine the financial viability of a project, only cash flow are used. If you are given depreciation, amortization, or provision, they are not cash item. You have to ignore it. It's not relevant. The next one will be interest. Again, it is possible in a question for examiner to give you interest expense. How do you treat interest expense in a question under capital budgeting? That's what we want to discuss. All right. This represents the amount paid on the loan borrowed, in the determination of financial viability of a project. The absolute amounts The absolute amount of interest is not relevant. The absolute amount, okay, I didn't put amount. The absolute amount what am I writing? The absolute amount of interest is not relevant and should be ignored. This is because the cost of capital, that is WACC, to be used to discount the future cash flows already included interest. You will recall that when we did cost of capital, we calculated cost of equity, cost of preference share, cost of debt. Then we now use all of them to calculate our weighted average cost of capital. You will recall that when we calculated cost of debt, for example, we included interest because we said cost of irredeemable debt is the ratio of interest to X int price, depending on whether you are given tax or tax is not available. So what we are now saying is that before you calculated your WACC, when you are calculating your WACC, you've already included interest. So when you are now given the absolute amount of interest, that is the Naira amount of the interest, let's say you are given interest of 10,000 Naira. So this interest is what we are talking about. The absolute amount of interest is not relevant because you've already included the cost of capital which you are going to use to discount the cash flow already included interest. Therefore, when you are given interest expense in a question, you are supposed to ignore it because it is not relevant. That's what we are saying here. So if the absolutes, if the absolutes or Naira amount of interest is included in the calculation, it will amount to double dipping. It will amount to double dipping. That is, it will mean that we are treating interest twice. So that's why you have to ignore. Anytime you are given interest expense in a question under capital budgeting, please ignore it. It is not relevant. Number 7, let's talk about opportunity cost. You can see what you guys are going through. That's to tell you that it's not easy to be a chartered accountant. A whole lot of effort is required for you to become a chartered accountant. It's not a day job. It's not a day job at all. Okay, so what do you mean by opportunity cost? This is the benefit foregone. This represents the benefits foregone as a direct consequence of the decision taking. So when you talk about opportunity cost, is the benefits that the company will not be able to earn as a result of taking a particular course of action. All right. Opportunity cost is a relevant cash flow and should be considered. So when you see opportunity cost in a question, you have to take it. The last one is working capital. What is working capital? This represents the difference between current assets and current liability. Current asset and current liabilities. Of course, is the amount required for the day-to-day running of a business. Working capital, WC. Working capital should be considered when determining the financial viability of a project. So how do you treat working capital? If you are given working capital, how do you treat working capital? So let's talk about it. So I said working capital, let me write it bigger, should be considered when determining the financial viability of a project and should be treated as follows. And should be treated as follows. So if you are given a working capital, how do you treat it? Number A, for a one-off working capital, how do you treat a one-off working capital? This should be treated as a cash outflow in the year before the year of occurrence. And recover fully at the end of the useful life. Okay. So that's the treatment of a one-off working capital. Let me explain this to you clearly. For example, if in a question, let's say you are given a working capital of 5,000 naira, and you are told that this working capital will occur in 2 years, will occur in year 2. Let me put it in writing. Do this. Let's do it this way. For example, if a working capital of 5,000 naira will be incurred in year 2, and the project has a useful life of 3 years. So how do you then treat it? You are given a working capital of 5,000 naira, and you are told that this 5,000 naira will be incurred in 2 years' time, and the project has a useful life of 3 years. So because it's a one-off, the working capital will be incurred only once in the lifetime of the project. So that means it's a one-off. So the rule says that it should be treated as a cash outflow in the year before the year of occurrence and recover fully at the end of the useful life of the project. So if I want to solve this, I would then create a column for year 0, year 1, year 2, year 3. The useful life of the project is 3 years. So I want to treat this working capital. Examiner has told me that the working capital of 5,000 naira occurs in year 2. We occur in year 2. So instead of accounting for this in year 2, year before year 2 is year 1. So I will then come here, year 1, I will record it, 5,000. The rule says it should be accounted for as a cash outflow in the year before the year of occurrence. Therefore, I have to put it in brackets. Then at the end of the useful life, the useful life is 3 years. So at the end of year 3, I will recover the working capital. When you recover it, the working capital will then be equal to 0. This is how to treat a one-off working capital. It should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. In this, our example, the working capital occurs at the end of year 2. So instead of recording it at the end of year 2, year before year 2 is year 1. So you have to record it in year 1. Then at the end of the useful life, which is year 3, you recover the entire working capital. So this is how to treat a one-off working capital. Then number B, which is the last one, incremental. How do you treat incremental working capital? Okay, incremental working capital. This is treated the same way as a one-off working capital, except that only the increments is considered or are considered. Only the incremental cash flows are considered. So for example, in fact, this is very common. This is the most common, this one is more common relative to a one-off. For example, examiner can tell you that a company will incur working capital in year 1, year 2, and then year 3. You can be given a working capital of 1,000 in year 1. In year 2, it must have increased to 1,200. In year 3, it will increase to 1,500. This is what examiner will give to you. Once you check your working capital given to you in the question, and they are not the same, So you can see increments in your working capital. You can identify from the question that your working capital is increasing every year. That means it is an incremental working capital. So in this case, how do you treat incremental working capital? The rule says that incremental working capital should be treated the same way as a one-off working capital. That is, the working capital should be treated as a cash outflow in the year before the year of occurrence and then recover fully at the end of the useful life. So in this our example, if I want to treat this working capital, first thing first, I need to determine the incremental working capital. So incremental working capital. The one that occurs at the end of year one is 1,000. So it still remain 1,000. From 1,000, let me shift it here. Incremental. Okay. Let me use a difference. Okay. So I will then come here. First thing first, I need to determine the incremental. I will say incremental working capital. These are the ones given to us in the question. So first thing first, the first one in the first year is 1,000 naira. This 1,000 naira has increased to 1,200 by 200 naira. The 1,200 has increased to 1,500 by 300 naira. So this represents the incremental working capital that we are going to record. The rule then said that this should be treated. So you can put relevant cash, relevant year. So the rule says that the working capital should be treated as a cash outflow in the year before the year of occurrence and then recover at the end of the useful life. So I can come here and put total. I can come here to put total. I will create an additional column. So the rule says it should be treated as a cash outflow. This is cash outflow. This is cash outflow and should be treated as a cash outflow in the year before the year of occurrence. This 1,000 that occurs at the end of year one will be treated as cash outflow in year zero. The 200 that occurs at the end of year two will be treated as cash outflow in year one. The 300 that occurs at the end of year three will be treated as cash outflow at the end of year two. Then the total will then be, I will add up everything together. This will be 1,500. So we recover the 1,500 in year three. So the rule says that incremental working capital should be treated as cash outflow in the year before the year of occurrence and then recover fully at the end of a useful life. The maximum working capital is 1,500. What you want to recover is 1,500. So this is the one that will then go to your calculation of NPV or internal rate of return or whatever the technique that you want to use. This is what that will go there. All right. You don't use 1,200. You don't use 1,500 because they are cumulative of the first year. So you have to find the increment, and it is that increment that you are going to use for the purpose of your calculation. So this is how to treat working capital. In some instances, in a question, examiner will not give to you the working capital, but you are going to be given, examiner will mention that your working capital will increase by 5%, 10%, 4%, 3%, whatever the percentage. So you are going to be given information about capital structure. You are going to be given balance sheet information or statement of financial position. You already know that working capital is calculated as current assets minus current liability. So you go to the balance sheet, you add up the current assets, okay? You remove cash. You remove cash or bank balance, then you less your current liability. So that will give you your working capital. So once you have your working capital, then you then apply the growth rate or inflation rate for you to grow it for the next for the years given to you in the question. So this is how to treat incremental working capital. And these are the line items that I explained to you that must be critically examined when you want to determine financial viability of a project. So for cash flow to be relevant, all these items I mentioned, all these 8 items, you have to examine them critically. Identify which one are relevant, which one are not relevant. So going back to the question that Anthony asked me, when I was explaining the other time, when I started this particular scope, I mentioned that when you want to determine financial viability of a project, or when you want to evaluate a project, there are 3 variables, right? There are 3 variables: factors, criteria, determinants, or attributes of project evaluation. And this include number A, relevant cash flow. And I've explained to you what relevant cash flows are, and then how to identify relevant cash flow in a question. Then number B now. Okay, number B, let me change this one so that it doesn't conflict. Let me change this one to I. Oh, my pen. My pen has stopped. It's not connecting. Quickly, we have about 3 or 5 minutes more to go.